Hey everybody, what is up? Welcome back to Final Trade. We're going to do a podcast style today, nothing to see, so just sit back and listen. Magic's had a rough couple of years, a few upward periods during that time, but mostly downwards. And, it all began arguably after the release of Modern Horizons 2 with the release of Adventures in the Forgotten Realms. And the hysteria of the 2020 era was starting to wane. Print runs were still way too high and probably remain so today. And then we started to see price increases first in the summer of 2022. We saw Magic 30, which was arguably the biggest price increase ever. And then we saw WotC swing for the fences with a somewhat normal set with the prices of Commander Masters, and the market utterly reject those prices. Now we hear that they are potentially raising prices again for Caverns of Ixalan coming in a couple of months. And there was a little bit of a bright spot at the beginning of 2023 after Phyrexia, and March of the Machines did okay. Then we got hit with Aftermath and eventually Commander Masters. So in the whole, the Magic market has been hurting and going down for about 2 years now, and a lot of good reasons for that to have happened. A lot of bad decisions coming out of WotC that have been the cause. But something I want to talk about is why I always remain an optimistic investor, whether it's in the stock market or TCGs or anything else that I'm investing in, and why I always say that the future is always bullish. And, there's always something you can do, even in a down market, that will improve your investment positions. And humans have this tendency to see a market going down, and I'll just speak generally of the stock market, but it applies in the TCG market also. But humans have this propensity to see the valuations of the stocks they own going down, and they panic, and the stocks go down a little more, and they panic a little harder, and eventually they start to sell, and the stocks go down a little more, and they panic even harder, and they sell harder, and they lock in their losses, and they destroy a bunch of their own wealth. And if you zoom out to the long timeline of something like the S&P 500 index, you'll see those little short blips that were things like the great financial crisis of 2008 and 2009. They're completely forgotten by the gains in the market in the 15 years since then. And I've known many people personally who panicked and sold during the lows of 08 and 09 to quote unquote protect what I have left. And now today they're trying to put kids through college after decimating their kids' college investment funds during that time period. And they essentially just signed up to work an extra 5 or 10 years before retirement because they panicked and they sold. And instead, if they had just held, they would have been fine. And dynamics are a little different in the TCG world, just the nature of the products that we deal with, the nature of the companies who essentially create, design, distribute the products, and the nature of the secondary market. It's liquidity and sometimes illiquidity, the lower volumes, the higher friction in the markets. Things are a bit different, but, at a high level, a lot of things operate the same. And when markets are going down and it looks like the end is near, there's always something you can do. And something that I always look for is arbitrage opportunities. And it's really nice in the TCG market because there are a ton of arbitrage opportunities. A few months ago, before Wilds of Eldraine came out, there was this kind of attitude that started going around, and I don't mean to say that it was wrong. I don't know if it was wrong or not, but there was this kind of meme that everyone's just going to buy singles, that, all the chatter is, don't buy the sealed product, just buy singles. And I don't know if the actual chatter was that or the chatter of the chatter was that. It doesn't matter. But I saw a take from another creator on YouTube, and basically their opinion on that was, well, if everybody does that, if everybody just expects to buy singles, no one's going to open any sealed product. And then, because no one's opening sealed product, the price of singles will go through the roof. And then it will, in retrospect, have been cheaper to just buy the sealed product instead of trying to just buy singles. And I think he got that wrong, because someone is always looking for arbitrage opportunities. They're looking for market inefficiencies in order to make money off of them. And if it had been the case, let's just say everybody had held hands and they had all agreed we're only going to buy singles. And so, even stores said, we're not going to open product. well, then the price of singles would have shot through the roof, and the price of sealed product, because nobody was buying it to open it, would have plummeted. And then someone would have defected and they would say, hey, wait, you mean I can buy that sealed product at a depressed price, open it, and sell the singles at inflated prices? And somebody would have stepped in, arbitraged the opportunity, and made money doing it. And in fact, that's what happens every day in the TCG market. There are always people out there looking for boxes that are mispriced, for deals from their distributors, for sales, and for collections they can buy, anything where they can buy something and then they can chop it up, resell it, and in net make money. And so there are always arbitrage opportunities, even right now, to do that in the TCG world. And, Rob from RNG Games, he made a video a day or two ago, and he talked about kind of pivoting his business a bit, because it seems his business has always been heavily centered around selling singles, but pivoting it a little more towards being that closeout person for distributors, for building that reputation with distributors that, hey, I've got the cash and I have the capability to take all this unwanted product that distributors want to get off their book at good prices and chop it down into singles and efficiently sort, list, sell, pick, and ship the singles to make money. And so he's pivoting in that way in order to make money even in this down market. He's seeing the opportunity there to arbitrage between distributors who want to get rid of unwanted sealed product that other card stores don't particularly want to deal with, and buyers who want singles. Something I always do on maybe a scale that's, 3 orders of magnitude smaller than what Rob does, is I just look for boxes that have inverted EV. And you've seen a lot of analyses on my channel in the last month, and I've done a bunch more over on Patreon for my subscribers over there, where I look at products out there. Hey, is there inverted EV? Is there sufficient inverted EV to overcome the friction in the market? And I've bought a lot of boxes in the last month, broken them down to singles, and put them up on TCG Player, and they're selling very well. So there's opportunity there. And at that level, the kind of tiny level that I deal in, peddling my small amount of singles on TCG Player, it's mostly products that have irrationally gained a bad attitude in the market. And of course, Baldur's Gate draft boxes are the best example. It's one of the most mispriced things in the market right now. Baldur's Gate is an amazing set. People love the singles. The singles sell wonderfully. They're priced very well, and there's incredible inverted EV in Baldur's Gate draft boxes. But so many people have such a lasting negative attitude towards Baldur's Gate because of the way WotC handled it last summer at release that they don't even want to entertain the idea that the market may actually really love the cards that are in the set and want to buy lots of them and be willing to bid the price of the singles up to the point where there's considerable inverted EV in the boxes, to the point that they're worth opening. They're worth overcoming the friction selling them on a platform like TCG Player with its fee structures. And so you can always look for things like that. Look at the products that people just have a terrible attitude towards, and think critically and say, is this really the case? Is it reasonable that people have these bad attitudes? Or can I construct a mathematical model of this product and figure out, oh, hey, there's a lot of inverted EV. I will be the person to step in, arbitrage that EV, and make the money off of it. And so a second more general way that you can try and create opportunity for yourself in bad markets is to be what we would call a counter-cyclical investor. And that's something I've done in the stock market for almost 20 years, and it's worked out very well. You basically look around and you say, what are the most unloved sectors of the market, or the most unloved industry within sectors, or unloved commodities, or, an unloved type of real estate, or anything like that. And you say, is it rational that this equity, that this stock, that this type of real estate, that this industry, whatever, is it rational that it's beaten down so hard? And, there's a couple of great examples of that, of course. The one that I always give because I bought hand over fist was oil and gas companies in 2020, when every idiot who could type on the internet was saying that we would just no longer use oil and gas. People would never go back to work. They'd never get on a cruise ship. Items would never transport across the ocean on vessels anymore. People would never get on planes. Diesel electric locomotives would never run again. And somehow they believed that oil and gas was done. And so I was buying hand over fist because obviously we're decades from that happening. And so those companies that I bought then at the end of 2020, they've more than tripled at this point. Plus, they're initiating very aggressive share buyback and dividend programs, and they're looking at record profits over the next couple of years and already. And so you can play counter-cyclically like that. Another good one during the pandemic was cruise ships. I didn't have the courage to actually pull the trigger and invest in cruise ships at the time, but you could look at how beaten down cruise ships were, and you could say, well, look, who's got the problem here? A cruise company that is not allowed to transport any passengers, or the banks that own the debt of the cruise companies that are not allowed to transport any passengers? You know, it's the old joke about if you owe the bank $1,000, you have a problem, but if you owe the bank $10 million, the bank has a problem. And so in that case, it was the bank with the problem, and they were obliged to keep lending money to cruise ship companies to keep them afloat during the pandemic until they could start taking passengers again. And there were only a couple out of all the cruise ship companies in the world that actually went bankrupt during or right after the pandemic. And so that kind of counter-cyclical investment is another thing you can look for. I guess another really good example from the last couple of years was Boeing. You know, Boeing crashed 2 planes full of people because they wanted to pay $7 an hour to outsource software development to India and not pay what it takes to safely certify new types of airplanes with radical changes over previous designs. And once the 747 MAX was grounded and people had lost faith in Boeing, their stock price plummeted. And all you really had to do was step back and look at it and say, well, you know, Boeing also builds the Apache attack helicopter. They build the F-18. They build the F-15. And just from the standpoint of those military airframes, the CH-46 also, just from the standpoint of those military airplanes, the government's not going to let them go bankrupt. But also, Boeing is only one of 2 really viable passenger airplane manufacturers in the world. And it's the only one of the 2 that's based in the US. Boeing is literally too big to fail. The US government will not let Boeing fail. And so Boeing would have been another one of those great counter-cyclical plays. Another great example is something like in the coming months and years, I think real estate investment trusts have a good chance of becoming a strong counter-cyclical play. Hopefully the Fed has the nerves to keep interest rates high at this, well, I say high, even though 5.5% to 6% is not actually high. It's high in our short-term perspective of 15 years of disastrous zero interest and near zero interest rate policy environment. But if the Fed has the balls to keep them at this relatively high rate for 3, 5, maybe 7 years, we can shake out a lot of the sickness and mispricing in the real estate market that accumulated over that decade and a half of zero and near zero interest rate policy. We can possibly get real estate prices down a little bit. We can at least fix some of the misallocation of real estate. And so there will come a point as we start to head towards that in the future where real estate investment trusts, asset prices, their stock prices specifically, will start to suffer, and they will become very attractive investments. And, you know, maybe that starts in 3 months, maybe it doesn't start for another 12 or 18 months. It's hard to say, but, you know, the effect of interest rates on real estate investment trusts is not one and done. It's not, the Fed decides to raise the rate to 5.75%, and in 3 months, all of the REITs will have adjusted, and then it's steady, smooth sailing from there. It's not like that. It's like a braking force that continually slows down the REIT more and more and more. And so, you know, you should always look for those kind of counter-cyclical investments. And specific to the TCG market, right now, when we're looking at Magic being just in a terrible place, Pokemon is a little bit down. You know, people are kind of... I think people are kind of overplaying Pokemon's position in the market right now. All of the Sword and Shield stuff is doing wonderful. And as soon as Pokemon Center's website runs out of Sword and Shield boxes to sell at MSRP, those prices are going to blast up. But the newer Scarlet and Violet stuff is performing appropriately. It's not even really performing badly, but coming out of this kind of shifted Overton window of the last 2 years, we look at $90 and $95 and $100 Pokemon booster boxes and we think it's the end of the world, it's terrible, there's no money to be made. But, you know, Pokemon's doing okay. Flesh and Blood is pulled off of all-time highs back in April, and it's sliding a little bit, a shallow slide right now. But Magic is what's really doing terrible. And so if you're a long-time fan of Magic, if most of your TCG investing had been in Magic and you look for those counter-cyclical plays, there's kind of two ways to make those plays. And one of them is, for the short to kind of medium-term outlook, it's invest more heavily in Flesh and Blood and Pokemon. And basically put less money into Magic while you have less faith in Magic. And the second way you can do it is, if you're thinking on the really long timelines of, say, maybe 10 plus years, is look for the most beaten down Magic products. Selectively invest in Magic, but only in the best things. And that's what I talked about with the bonus bucks sale recently, and afterwards in Friday sealed deals for maybe the last month or so. I've been saying, if you're buying Magic right now, you need to focus on quality. You need to focus on things that are out of print and half premium and premium sets. Avoid standard for a while longer. You know, we're on 3-year standard rotation, so there's plenty of time to be very selective when you buy any standard at all. But focus on those best assets within Magic, and then just take the long 10 plus year timeline and wait that out. And so you can be counter-cyclical to Magic's current problems in that way. So, you know, I think the future is always bullish, and like I always try to emphasize people, if you zoom out to the longest time scale on that S&P 500 index plot, it's up and up and up and up and up. And almost every individual stock does that. Very few stocks in the grand scheme of things go to zero. Very few assets ever go to zero. And most assets and most collectibles increase steadily in price over time. And I've done plenty of analyses on this channel showing the overall long-term, multi-decade performance of things like Pokemon and Magic. They perform very well in the long term. So don't lose sight of the long term when the value of your current positions is suffering on the short term. Don't be the person who says, I have to protect what I have left, and you sell at a low, lock in your losses, and then end up hating yourself for it a decade from now. So look for those opportunities to find other ways, play the counter-cyclical plays, look for the arbitrage opportunities, and realize that even in a down market, there are ways to improve the positions of your assets. Let me know what you think, guys. Thanks to everyone who makes this content possible, especially my supporters on Patreon. Like, comment, share, and subscribe, and join me on Final Trade.